understand from the topics and the title, we will try to cover the FX market challenges and outlook in the second half of 2025. By the way, as I said, you may ask all your questions at the end of the session. Don't forget this. Let me go here. The first slide is about the DXY. Maybe some of you familiar with the title of the what means we buy the DXY. DXY is the dollar spot exchange rate in the FX market, and we are trying to explain this by combining some reserve currencies. This is fixed reserve currency here, as you see. This is Euro, Japanese yen, Great British Pound, Canadian dollar, Swedish krona, and Swiss franc. And here you will see the weight of these currencies. These currencies are, as I said and explained, Euro, Japanese yen, and Euro weight in the basket is approximately 58%. And just let's take focus on the first three here. If any volatility and the changes happening in the British pound, Japanese yen, and the Euro, approximately we will get the 80% of changes in the dollar spot exchange rate. So these three big currency in the spot market make the volatility in the dollar spot exchange rate approximately 80% coverage, and weighting from this side is common. And also we have three small currencies like Canadian dollar, Swedish krona, and Swiss franc. By the way, these six currencies in the basket generally hold in the central bank as reserve asset, ladies and gentlemen. This is important. For instance, we have approximately, I don't exactly remember, but approximately we have 190 countries in the world. Okay, and we have separate categorization for these countries like G10, G7, G8, or emerging market, or developed market, or developing market. For instance, as you see here, there is no Brazilian real, or there is no Mexican peso or Indian rupee here. These are emerging market currencies, and these are really volatile. For that reason, every emerging market country's central bank hold these six currency as reserve currency in their balance sheet, in their central bank. Why? Because if you go to, let's say, in that northern country, like the Norway or Scandinavian country, if you have your Euro or Japanese yen in your wallet, you can directly convert it and you can easily convert those currencies. But for instance, the Kazakhstan tenge, or let's say the small countries like the Egyptian pound, these are not easily convertible currencies, and these are not as how can I say this word? This is not a familiar currency for the rest of the world to make an easy conversion with the Euro, United States dollar, or Great British Pound. For that reason, to understand this concept easily, you should understand that these six big currency, additional to the United States dollar, this is against United States dollar a spot exchange rate. This is making a basket with this weighting, and any changes in these currencies making upside or downside risk on the dollar spot exchange rate. So if I focus on what is happening in these different currencies, please look at the intraday chart on the right hand side. This is 17 and 18 September. Please take a look at here. Yesterday we had a Federal Reserve Open Market Committee, and when the Fed cut the rate and make a presentation about the rate cut and job market, first the market reaction is sudden sharp decrease in the DXY spot. Then from there on, from 96, then we reach approximately 97, an increase in the dollar spot. This means dollar index is strengthening. meaning dollar is appreciating against euro, Japanese yen, British pound, Canadian dollar, Swedish krona, or Swiss franc. Dollar fighting every currency if this index is going up. And if this index is going down, dollar is depreciating. So euro is more stronger, or Japanese yen is stronger than the dollar. An increase in this index, meaning dollar strong. A decrease in this index is dollar, meaning depreciating. So let's pass to the second slide. Throughout the world, everybody wondering about this question. Yes, we have a weighting here. Approximately 6 currency with this weighting. The total sum is 100. And this index is accumulating for the dollar spot index. But what is the exact reason behind the dollar spot index is increasing or decreasing? What is the triggering point behind it? Please take a look at here. From 2000 till now, approximately 25 years we are covering. This is the dollar spot. In the dot-com crisis, dollar spot is approximately 120, meaning 20% appreciation against this 6 currency from the dollar. Dollar is 20% stronger than this basket. But after the dot-com crisis and with the start of the global financial crisis, dollar spot decreased approximately 70%. What does this mean for us, for investors? Why the triggering point here, sudden sharp depreciation of the dollar? Because here the United States Federal Reserve started an quantitative easing policy, meaning that the Ben Bernanke on the helicopter printing the money and distributing to the rest of the world. Please remember that picture. The Bernanke is a helicopter and distributing and spreading money to the rest of the world. If the money supply increase for the United States dollar, its real value is decreasing, ladies and gentlemen. Because there are excess supply of the dollar, its real value is decreasing. And we reach and test the value of 70 in this index, meaning that euro is stronger than approximately 30% the United States dollar. And from there on, we have lots of volatility. But if I just take a look at this chart, how can I understand that? What is the exact reason behind this decrease or increase? Please take a look at the right-hand side chart. There are 2 charts here. And if you take a look at for the 2 currencies around the world, you should basically understand that. Let's say lots of people coming from the Africa, and let's take the African, one of the African currencies, South African real or South African currency. If I want to understand that how the South African currency move up and down against the United States dollar, I should take a look at 2 things between United States and South Africa. First, the trade balance. If the current account surplus is coming from the South Africa or United States giving a current account deficit to the South Africa, this means that South Africa exporting more goods and services to the United States than it is imported from the United States. So if you export lots of things to the United States needs your currency to buy that, right? So your currency is appreciating. First thing is trade balance. You should keep in mind that if your country giving a trade surplus to the other partners, your country's currency will appreciate against those currency because they need your money to buy your goods and services. This is the first thing. Okay, is this point clear? I mean, if your country giving a current account surplus or trade surplus, any trade partner, your country's currency will appreciate to those against other trade partners. Why? Because they need your money to buy your goods and services. And second thing here is the interest rate spread between your country and that country's long-term outlook. What I mean by this? Today,
the United States 10-year Treasury yield around 4.2. And let's say 10-year Treasury yield is approximately 15% for the South Africa. And difference between the United States and the South Africa, or South Africa minus United States, 15 minus 4 is 11. Your country is offering higher return if you buy the fixed income asset. For that reason, money likes the interest return. Money goes from the countries which has lower return to the countries which has higher return. For that reason, money flow from United States to the South Africa to take a higher return on their 10-year Treasury yield. Because United States offering 4%, but the South Africa offering 15%. The money market will flow from United States to the South Africa. But let's say South African Central Bank decided to decrease their policy rate approximately 500 basis points from 15 to the 10. Then this is an increase in risk aversion, and risk appetite will decrease for the United States investor, because in the beginning, from 15 minus 4, they are earning approximately 11%. But now the South Africa is offering 10%. 10 minus 4 is 6. In the beginning 11 and now 6. There is a decrease for the United States investor. They will not more invest to South Africa. So South African currency will depreciate or decrease against the United States dollar. This is the basic structure of how the money market and foreign exchange markets appreciate or depreciate against a base currency. This is the base currency, and your appreciation or depreciation will decide on these two factors. First, the current account balance. Second, the interest rate differential or spread between the countries. And now, this is the one-day chart. Please take a look at here. This is 1 day, and from yesterday to today, September 17 to September 18, base currency is the United States dollar, and I'm taking the basket for the major currency. So please focus on this side. This side means that it is red, by the way. It is meaning that this currency is depreciating or losing value against the United States dollar. Why? Because yesterday, as I explained a few minutes earlier, United States decreased the interest rate, and dollar is getting strength. Here, normally you may ask this question, Dr. Kadir, a few minutes ago you said that if the country decreases the interest rate, that country's currency should depreciate. But here, the biggest currency is depreciating against the United States dollar. There's a risk reversal here. What is the reason? Because when the United States dollar decreased their interest rate offering, as I say, now the money investor going to the emerging market to take higher return, because United States investor will now on anymore getting lower return in the United States. They are going other countries. But when compared to these countries, still United States 10-year Treasury is really high. They are getting higher to these countries, but Brazilian 10-year Treasury is higher than United States. So Brazilian real appreciating, but New Zealand dollar or Singapore dollar is depreciating, because these United States still offering higher 10-year Treasury yield from the Singapore, but lower Treasury yield from the Mexico. Okay, this is the basic logic behind how this interest rate differential between the countries, how the central bank decision-making process may affect the appreciation or depreciation in the countries. This is the first day show after the Federal Open Market Committee assessed and their real appreciation or depreciation. But if we change the picture to the longer term, For instance, for the 1 month, please take a look at here. I'm taking the 1 month from August 18th to the September 18th. Again, the basket is the United States dollar, the base currency is United States dollar, and I'm taking again measured currencies. If I take a little bit longer term rather than 1 day, if it is a 1 month, every country's currency except Taiwan and New Zealand dollar appreciating United States dollar. Why? Because the job market, inflation outlook is decreasing the risk appetite in the United States, and funds from the United States escaping to these countries. And this is depreciating the United States dollar. Even Norwegian krona, Brazilian lira, Swedish krona, Australian dollar, or Euro Danish krona, every country is fighting the United States dollar because they are offering higher return with less risk. This is important. You are offering higher return, but also your risk is really low in these countries. And now I'm changing my perspective a little bit longer term. I want to take a look at in mid-term and long term of the currency outlook. And this is 3 months. Now it is a little bit volatile. For instance, if I take a look at for the 3 month outlook, here, as you see, some of the developed countries like Canadian dollar, Japanese yen, losing strength against United States dollar. But the emerging market like Brazilian real, like Mexican peso, or like South African rand, these are getting strength. But also Swiss franc, even a developed market currency, is fighting the dollar in the 3 month outlook. You should understand the spot return in the basic concept. A few minutes earlier, I tried to explain the basic logic behind it. Two things you should take a look at: the interest rate differential, the offering of the total treasury return between the countries, and second, the trade balance, current account balance between the countries. If your country is giving trade surplus, or if your country offering higher treasury yield return, your country currency is appreciating against the base currency. This is the basic concept. And now I'm taking a little bit longer and longer term for the 12 months, 1 year, from the September 1824 to September 1825. Again, base currency is the United States dollar. Now, almost all developed market countries' currency, except the Euro and Swiss franc, these are depreciating against United States dollar, Canadian dollar, Australian dollar, Japanese yen, and New Zealand dollar. These are depreciating against United States dollar because lots of people understand that from there on, at the beginning of the 2025, lots of investors expecting from the Federal Reserve not to cut interest rate higher than 2 times. But yesterday, the Jerome Powell declared to the rest of the world there are more additional 2 rate cut in the United States. But at the beginning of the 2025, nobody is expecting something like this. And at that time, United States higher return appreciating the United States dollar. But now, lots of market makers expecting from the United States dollar the rate cut will be higher than 2 or 3 times. For that reason, in the longer perspective, in the 12-month perspective, the even except the euro and Swiss franc, lots of developed market currencies depreciating. When I take a look at the shorter term, almost all currency is appreciating against the United States dollar because now the market policymakers expecting that United States policy rate will go down. But here, when they look at for the long-term perspective at 24, they are not expecting the Fed cut the interest rate at this much. Okay, you should understand the logic like this. Now, while I'm taking a look at the spot return, please take a look at the title here. Title are here in the short and long term. These are basic spot return in the currency market. But now
I'm taking the implied volatility. What I mean by implied volatility? Sorry. Implied volatility meaning that this is the 1 month implied volatility against the United States dollar in the major currency basket. Okay, the perspective, the term, the maturity is important. This is 1 month volatility, implied volatility against United States dollar in the basket of major currency. What does this mean? I am taking a model. This is the volatility model, expecting volatility model, like the volatility up and downside risk in the standard deviation of that currency. In the next first month, not next couple of months, just 1 month later, how much I expecting this currency may volatile against United States dollar. As you see here, almost all currencies implied volatility is positive, like Brazilian lira, like Swedish krona, like euro, like British pound. This implied that there is an upside or downside risk. This does not mean that this will go up 6%. This means that this can also decrease 6% as well. Implied volatility means that upside and downside risk around 7%, or upside and downside risk in Brazilian real approximately 11%. In financial markets, while you are making your investing decision, always keep in mind that volatility is positively correlated with return. Higher volatility meaning that higher return. Lower volatility meaning that lower return. For instance, Brazilian lira here in the almost all picture getting higher spot return against the United States dollar. Why? Because it is implied volatility is really high, ladies and gentlemen. But if the implied volatility is low in that currency, it is spot return will be stable. It will not go up 10% or go down in 10% because it is a stable currency, like the dollar spot exchange rate basket. I assume that you also get the picture from the implied volatility, meaning appreciation and depreciation. For instance, for the British pound, the volatility is just around 4-5%, meaning that in the best case, British pound can appreciate against United States dollar 5%, or in the worst case, in the storm, in the negative turbulence, British pound can lose the value against United States dollar at most 5%. But for the Brazilian real, this is approximately 11%. So why this is important? If you are in a hedge fund, if you are in a portfolio management, you should make the risk management. How much you are ready to lose or you are ready to get the return from that currency. For instance, we have lots of investment at a stop point, right? Get the profit or make the stop. Here for the British pound, let's say Dr. Albert is a risk averse person. If he lose 10% in their money, he will be really angry and he will not accept this condition. So if Dr. Albert don't want to lose higher than 5%, Dr. Albert don't put any money for this side. Because here the volatility is higher than 5%. You should put your money only in these two currencies if you don't want to accept any negative loss higher than 5%. This implied volatility is a really important indicator for your risk management perspective. And the CDS. Lots of people, I'm sure, hearing this word around the world every day while they are making their risk management perspective, while they are making their upside and downside risk. What the CDS? First of all, let's take a look at its explanation. CDS meaning credit default swap. Credit default swap is your CDS. For instance,
For the South Africa, the CDS is approximately 150 basis points. But for the Switzerland, it is just 7. How can I explain the best methodology under the CDS? It is like this. Let's say here, Dr. Lambert has a car, right? And for any type of accidents, he's buying an insurance policy, insurance package, right? And let's say last 3 years, Dr. Lambert don't make any accident on the street. His previous experience in the traffic is really good. Don't have any negative side. And when the Dr. Lambert go to the insurance market, like Allianz, and if, ladies and gentlemen, please don't move your mouse on the screen while I'm reflecting the slides because you are blinding it. Ladies and gentlemen.
Abdulkadir, do I have to erase that circle around South Korea?
No, I didn't do that. Somebody else.
Okay, I will erase that.
Okay,
there you go.
Lambert. And as I said, Dr. Lambert go to the Allianz. He want to make an insurance. He want to make a buy for his car and insurance package. And Allianz look at how many accidents Dr. Lambert make last 3 years. And they see that there is no accident. This is a signature for the Allianz that Dr. Lambert is a really good driver and they can decrease their risk basis for the Dr. Lambert while they are offering the risk insurance policy. Why? Because even they put the package with lower money, Dr. Lambert will not make accident, right? Because he's a really good driver. Last 3 years, he didn't make any accident. Dr. Lambert is Switzerland, ladies and gentlemen. Okay. But let's say I go to the Allianz and Allianz look my previous experience on the traffic and every month I made an accident. I'm a really risky driver for the Allianz. And if Allianz, let's say for $1,000, make a coverage for me, and if I go to the traffic, I can bring with a claim policy to the Allianz for $50,000. I'm a really risky driver for Allianz. And Allianz is increasing my risk premium for the insurance policy. And I am the South Africa, ladies and gentlemen. Okay. I have a higher risk while I'm borrowing money in international market. Credit default swap is your insurance policy against your borrowing in the international market. Let's say Dr. Lambert is go to the international borrowing market and he wants to buy a syndicated loan. Okay, basic syndicated loan from international market. And let's say his TDS is just 7%. 7 basis points. It is nothing. Like the, let's say, the international money market giving the offering from 2%, they will not add any cost for Dr. Lambert. But when I go to the international market, and if the borrowing cost is 2%, they will increase 150 basis points, and I will borrow from not the 2%, but 3.5%, because I'm risky. Okay, they are making insurance for my borrowing. And if I cannot pay my borrowing to the debtors, the insurance market will pay this. So I should pay higher risk premium to make an insurance policy for international borrowing. This is the CDS spread. You should keep in mind like this. CDS is the basic insurance policy for your credit default swap. If you go to a default, okay, in other words, if you go to the default, how much risky you have and how much higher premium you should pay if you go at default. This is the basic explanation for the credit default swap. And another thing, is in real effective exchange rate in a fixed market. This is also really important point. Here I'm taking as of today the real exchange market appreciation or depreciation, and the basket is again the major currencies and the source from the BIS, Bank for International Settlement. This is the bank of the central bank. Okay, every central bank is connected to the BIS, and this is the Z score. And what I mean by real effective exchange rate. Normally, I have here, let me go here. For instance, here I have currency, but when I speak about the real effective exchange rate, it is your purchasing power in the international market. Nominal exchange rate is nothing, ladies and gentlemen. It is just an indicator for the spot market. But if you want to understand how much your currency is strong or how much it is weak, I mean, how much purchasing power it is giving to you, or how much really risky and weak purchasing power in the international market you have, you should take a look at the real effective exchange rate. Why? Real effective exchange rate is a combination of the nominal spot market adjusted with the inflation. This is really important. I'm repeating it. The real effective exchange rate reflecting the purchasing power, and it is adjusting the nominal spot exchange rate with the inflation, price dynamic. For instance, if your country's nominal exchange rate is really higher, and if you suppose that you have really higher purchasing power, this is not correct. Because also in your country, if you have higher inflation, your purchasing power is decreasing. Okay, for that reason, I'm adjusting my purchasing power with respect to price dynamic, the inflation outlook, then I'm getting the real effective exchange rate. And as you see, the real effective exchange rate is strongest in Swiss, meaning Switzerland, and the Euro area. Their purchasing power is really strong. Their money is really strong. For instance, for the South Korean won, we cannot say the same thing. Even the South Korean won appreciating against United States dollar, it is real effective term can be negative because of the inflation outlook in South Korea. Or if I take a look at for the South African rand, even their country's currency is appreciating, again, their purchasing power can be negative because of the inflation in South Korea. These are the nominal effective exchange rate. As I said, from this basket, this nominal effective exchange rate like 123. Okay, meaning that please take a look at the benchmark as 100. So if you are at 100 and if you are in 123, meaning that Brazilian real 23% higher value than the United States dollar. Or if you take a look at this one, Euro is in nominal market higher value than the United States dollar 10%. But for the Japanese yen is lower value than 25% the United States dollar. This is the nominal market. But then if I go to the real exchange rate, it is reflecting my real purchasing power in terms of the different currencies around the world. And last two slides, I want to explain here the commodity price and FX in commodity market and short-term rate. For the Australian dollar, I reflected. Australian dollar, you know, Australia is one of the best well-known economy who's exporting commodities like iron ore, like gold. They are exporting the commodity. And the commodity price is really affecting their FX market. Here, as you see, commodity price index, and here you see Australian dollar, United States dollar parity. And if the commodity price going up, Australian dollar going up as well, meaning that because Australia exporting lots of commodity, they are collecting other currencies and Australian dollar getting strength. But if the commodity index going down, Australian dollar losing strength as well. So if you are one of the best well-known exporter of any commodity like Russia, if the Russia is one of the best well-known exporter of the natural gas or petroleum products, and if the oil prices go up $100, Russian ruble will be appreciated against United States dollar. Okay, because Russia is exporting natural gas, and if the natural gas price is going up, Russian currency will be appreciated against the United States dollar. And here short-term rate and FX, and here in the beginning I reflected it here. This is the longer term yield, but it is correlated with short-term yield as well. And if your short-term yield is going down, your country's currency will go down as well. So if you offered higher spread between the country's interest rate, your country's currency will appreciate. And if you go down in terms of the interest rate differential, your country's currency will depreciate against the base currency of the United States dollar. And last things from my side today is global currencies 225 year to date against the United States dollar. United States dollar spot index DXY approximately decreased 4% at the beginning of the year till now. And here I have the countries like Brazil, Euro, Japanese yen, Switzerland, and here Turkey. This is my country, the most depreciation because of the inflationary outlook. But like the Euro, Japanese yen, UK, and Switzerland, they are appreciating against the United States dollar. But like Taiwan, because of the crisis between China and Taiwan, like Indonesia, because of their interest rate policy and FX market outlook, and like Turkey, because of the inflationary dynamics, they are depreciating against the United States dollar. And here, again, United States dollar and interest rate differential showing the exact positive correlation between the interest rate spread and the country's dollar index. If your interest rate spread decreasing, dollar spot index is decreasing, or the vice versa. Ladies and gentlemen, today I tried to cover what happened until today at the beginning of the 2025 and what type of risk can be happen in the United States and developed market and emerging market. And we try to understand what can the basic point behind the currency's appreciation and depreciation. What can be the fundamental reason behind the United States or developed market or emerging market currencies and how they can move each other and what type of volatility can be happening in FX market and what are the basic reasons behind those volatilities. Thanks for your patience today to listen my presentation. And now the microphone at your hand. You may ask your any type of question.